Okay, good afternoon, everybody, and welcome back from the lunch break. We've got a session now that's going to run for about 45 minutes, focusing on stewardship and the governance around stewardship. We have an excellent panel for you. It's going to be a conversation rather than scripted remarks, and so we'd encourage throughout you to raise hands if you've got comments or questions, or use a Slido, which you can use the QR code up in the corner of that screen. So the title I've been given is Navigating the Labyrinth of Stewardship and Governance. And my opening question, I'm going to look for a yes or a no from my panelists, followed by a short explanation, is whether or not stewardship is delivering. Delighted to introduce our first panelist, who's Caroline Escott, who's representing Railpen. Caroline, is stewardship delivering?
Yes, with caveats, that's really
okay.
Right, so I can explain. So there are examples, and I think we've seen in lots of people's stewardship reports, where stewardship is delivering real value, it's well targeted, it's thinking about the issues that are most material, both at a bottom-up level, company-specific level, and at a sort of top-down, system-wide level as well. However, I think it's got a long, long way to go. I think generally there needs to be more resourcing in the industry, in terms of funding, in terms of headcount. At Railpen, we're very lucky. I definitely cannot complain about the resources we get, but on an industry-wide level, I think more needs to be done there. I think there's more of a need for people to be laser-focused about cutting through the noise and not necessarily just trying to do something on the latest hot topic of the day, but really thinking about whether or not that's tied to financial outcomes as well. And then the final thing I'll say is that when it comes to system-wide stewardship, and many of us are increasingly considering ourselves to be universal owners of assets, I think there's a greater need in the industry for people with a bit of a either public policy background, because if you need to achieve system-wide solutions, you've really got to think about tackling that regulatory framework. I don't think many people have that background yet, and where they don't, and this isn't the only way to do it, but I think they should be working much more closely with their government relations and public policy teams that often are sitting within the same organisation they are.
Okay, super. So thanks, Caroline. So it's a yes with caveats. Catherine Howard, ShareAction, is stewardship delivering?
No. How about that?
1-1. Right.
Disagreement already.
Yeah, love it.
Of course, there is some fantastically effective and really good stewardship going on out there, including here in the UK. But there's also a lot of really underpowered stewardship, which takes the form of endless, slightly circular chit-chats that just don't deliver real risk mitigation, real value add. So I'm going to be provocative and say no. And also I'm pointing in part to the fact that obviously the United States has a vast asset management industry. It's the biggest in the world. A lot of global assets of asset owners all over the world are invested by US asset management firms, and this has all become really problematically politicized in the US, and the upshot is that large numbers of US managers have just stopped voting with conviction to address environmental, social, and governance risks, and just routinely and only vote with management now. So I think that's a real failure of stewardship, and that we can maybe talk about it later, but I think there's a real need for asset owners that use those managers to really challenge and to kind of really scrutinize what's going on and whose interests are being served when your US managers used to routinely support shareholder proposals, for example, on environmental and governance questions, and now don't.
Yeah, hang on. I'm going to pause you there.
Okay.
We're going to get to it. Let's just do a quick show of hands. Is stewardship delivering? I want you to vote, so I'm going to force you. So either a yes or a no. Is stewardship delivering? Those in favour and saying yes, stewardship is delivering. I've got 1, 2, 3, 4, 5, 6. So just to make sure that people aren't just being passive, is stewardship not delivering? Yeah, interesting. All right, Leanne Clements, People's Pension, what's your view? Stewardship delivering?
What do you think I'm going to say? I'm with Catherine. The answer for me is no. A lot of the points that I was going to raise have been touched on already, but bears re-saying. I think that the stewardship program that we have today needs to explicitly acknowledge the importance of industry and policy engagement as core to stewardship activities. That currently doesn't exist. The prioritization framework, when I ask fund managers about whether they have, what is their targeted approach to engagement that's rooted in a robust theory of change, justifying the resources that they're spending in the right places to achieve maximum impact, the answers I get are a bit weak. So I think there's a lot of work that needs to be done there. A good example that asset owners could be testing as to whether their manager has a robust prioritization framework would be whether they're spending a disproportionate amount of resources on the on oil and gas sector and should be focusing more on demand. Looking at things like there are certain aspects of a transition plan that maybe should be given more weight than others, like corporate lobbying, for example. And all these things need to be tested. So just saying that you have a robust prioritization framework isn't good enough. Asset owners have to test that with various different things. A systematic, I mean, Catherine's touched on this, but especially when it comes to climate stewardship, we are at a point now where a more systematic approach to voting needs to happen, with more the director elections, audit, et cetera, is being underutilized, or routine agenda items. And I have to ask that question that is a bit controversial, because I know there's a lot of people in the industry that are very supportive of shareholder resolutions. And all I will do is just ask fund managers in deciding to allocate resources, or anybody allocating resources to shareholder resolutions, to defend why they think that is the most effective use of their limited resource, as opposed to going with the routine agenda items on the AGM. And then finally, I mean, the most important thing to me is reporting, right? It's very hard to say that, how can we even say if stewardship is delivering if I'm not getting enough reporting from my managers to even ascertain that to begin with? So there's a lot of work that needs to be done in that space as well.
Okay, super. So I'd like, AV, if we could put up the first poll, which is asking you to think about the biggest barrier to effective stewardship, while I turn over to Jim, who works for Trustee Decision Limited, and ask the same question. And Jim, I want to throw in something else around paying for stewardship. Good quality stewardship costs money. And I'd like to ask, for you as a trustee, are you prepared to pay more for your fund managers to undertake good stewardship?
Okay, well, first of all, I suppose declare that I'll side with Catherine and saying no. I don't think it is delivering. It's delivering, but what is it delivering? What is it giving of value to the trustees? So speaking as a practitioner, it delivers a lot of overhead. It delivers a lot of data, but not necessarily good information. I was delighted this morning to hear Sonia saying from Elgin that the asset manager doesn't own the money. It's not their money. Actually, the trustees don't own the money either. It's the individual members. So to the extent of whether you're prepared to pay for good stewardship or not, I think that the clue is in good. What are you getting for what you're paying?
Yeah.
And I know we've discussed that shift to passive versus active, and the overhead cost that comes with that. I think trustees want something that they can get their head around, that they can get their hands around, that they can understand. And a lot of the information that we get from the asset managers is is generic. And I feel strongly sometimes that while we might get feedback from the asset managers, we very rarely get asked for feed forward.
Yeah.
Really understand, what do the members of the scheme want? What do the trustees as the representatives want? So it's a challenge.
Okay, all right. So let's just recap. We've got a question around whether or not stewardship is effective. Most of the audience think no. Caroline said yes, but with caveats, and then set out some quite clear views on how to enhance and improve stewardship. Let's now try and unlock what we think are some of the challenges and the barriers to stewardship. And let's get on to this, whether or not asset owners are prepared to pay for it. And we do have two asset owners on the panel. So I'd like to come to you, Caroline, and this is easier said than done. So just talk us through how you think about the cost and value of stewardship.
I should point out that we have a very different investment arrangement and approach to many other pension schemes. So we are the in-house manager for the Railways pension schemes. We have many open defined benefit sections, so we're continuing to grow. In 2013, we went on an investment transformation program where we started to internalize more and more of our asset management across most asset classes. And we now manage the vast majority of our assets in-house.
Yeah.
So to answer your question about resourcing, yes, we're willing to put the money into resourcing stewardship with our in-house team. We have the scale, we have the investment expertise to be able to support, I think, possibly one of the largest teams when it comes to sort of stewardship and sustainable ownership of a UK pension scheme.
Would you have a, so the UNPRI, Principles for Responsible Investment, undertook a study around how much asset managers predominantly are paying for stewardship. And they came out at around 10%, and they encouraged asset managers to double that. Do you have a view around what your cost base might be on stewardship as a percentage of the fee that your members pay?
We're rerunning the analysis at the moment.
Okay, interesting.
Yeah.
I mean, when you think about, if you accept the argument that stewardship is the most effective lever you have to drive change, and most asset managers are spending $1.10 on that, you sort of wonder where the other 9 in 10 is going, right?
I can totally see that. I'm not in charge of the internal figures. We're not running, or at least I'm not in the middle of running them at the moment.
Okay, all right.
Did they subdivide that out into passive and active?
Say again,
in terms
sorry?
of that, did they subdivide that out? In terms
I don't think so. No.
No, it was an active. Okay.
So, Leanne, your view: are you prepared to pay more for high quality stewardship?
Well, I think before I would be prepared to pay, I'd have to sort of solve for a few equations first. So my point before about sort of prioritization is key. So are you using your resources most effectively? Because if it's ineffective, then why would I want to just throw money at more ineffectiveness, right? So we need to solve for some of these equations first.
Yeah.
And if they did solve for those equations, then I'd be prepared to have a discussion around it. In terms of myself, and I think it's very fair, okay, we can point the finger at fund managers here as asset owners, but I think the question I could ask of myself, what would I be prepared to pay for myself in terms of in this space? And it would definitely be an asset owner collaboration focusing on policy engagement, on systemic issues, bringing in policy expertise, to Caroline's very good point. That is something I'm prepared to pay for.
Okay.
And yes, I recognize the value of IGCC, UCS, et cetera, and lending our AUM to the letters they send, et cetera, very useful. But what is specifically attractive to me about what I've just said is having an asset owner focused collaboration on policy, so that asset owner interests specifically are being considered in that collaboration.
Okay, that's clear. We're going to come back to that. But the second one on the poll that the audience identified is around ineffective regulatory structures. And Catherine, I'd like to bring you in here, and I didn't include this in the EG, but let's also include the Stewardship Code consultation. I wonder if, before we get into your view on a Stewardship Code consultation, you could just give us, to the best of your ability, this is an unfair question, but a factual, what are they proposing?
Oh gosh. So they are proposing a very, in my view, meaningful change to the definition of stewardship, stripping out environmental and social considerations as an explicit part of the definition. That had come in 2020. They're proposing to strip out the principle that says good stewardship includes escalation, something I think is fundamentally important to giving credence and credibility to stewardship and stop it just being circular chats. And there are various other things. So yeah, you have put me a bit on the spot, but there's a couple of really critical and some very, very welcome proposal to streamline reporting requirements around the code.
Okay, so let's just focus on the definition. What's your view on whether or not that change is welcome?
Mine?
Yeah.
Yeah, I don't welcome it because I think we had, moved on from thinking. I mean, what it moves us back into is an approach that says stewardship is only about extracting financial outcomes. And of course, that is critical. You invest your capital to secure return. But what we know in a world of systemic risks where major corporate entities and other, let's say, infrastructure assets have enormous impacts on the world, that the essence, I think, of responsible ownership and responsible stewardship is to have a rounded approach to looking at those assets and thinking, how do they perform for my clients or my beneficiaries? And so I think it's just really unhelpful to strip away what was starting to get really positively embedded, and which I think absolutely meets, for example, a millennial generation investing in pension schemes completely expect this. My own pension scheme is Nest. When they do polling of the 13 million people in the UK who are a member of Nest, they completely expect the scheme to be fully engaged with all of this. So to have then the government's stewardship code stripping that all back just feels like, oh my goodness, such pity. But anyway, it's only a consultation.
Yeah.
So it's absolutely on all of us to make this case. And I hope that people attending this conference, for example, will really take a moment to look at it, respond, interact with other people who are also code signatories, and ensure that the FRC is really listening carefully.
All right, well, let's see if the audience agrees with you. So this might be a smaller subset of you, but if you're familiar with what the consultation is proposing, so that caveat, otherwise your vote's probably not that useful for us, are you in favour of the change of the definition of stewardship or not in favour? Let's do those in favour first. Those not in favour. Super.
Oh, wow.
So I'm not sure you want to comment at this stage, Caroline, Leanne, is that right?
I would say that we were really happy with the stewardship code as it was.
Yep.
We thought it worked really well.
Yep.
We thought that the stewardship code reports we got from the few asset managers, external asset managers that we do use,
Yep.
were the most useful firm level reporting. And we thought that the changes of the 2020 changes were really worthwhile.
Yep.
I should also point out that we have to prepare our own stewardship code report as a signatory. And actually that is a really valuable formal opportunity for reflection, probably the most valuable formal opportunity we have out of any of the reporting that we produce. So
Okay.
I'd have been keen to see no changes.
Yeah, okay.
Not too late. It's not a done deal.
Yeah.
No,
Yeah.
no. We will be feeding.
Leanne, anything to add at this stage or not?
Just a tagline, and if it ain't broke, don't fix it.
Yeah, okay. All right, I want to move on to you, Jim, and I've got a couple of questions for you around the other regulatory disclosures. So I'm not so familiar with the Irish market, but in the UK, pension schemes also have to disclose their most significant votes, their implementation statements. Nobody reads them. They're legalistic documents. They cost, this is real money. This is hairdressers and Uber drivers paying money for disclosures that aren't read, aren't useful, don't change decision making. Just tell me a little bit about some of the frustrations, if I can use a loaded term in the question,
Sure.
that you have around the disclosures you're responsible for.
So for starters, I mean, clearly the Irish market is considerably smaller than the UK, and the number of pension schemes has been dramatically reduced in the last year, 2 years. So we have a very significant move of DC schemes to master trusts. You will have seen numbers quoted by the regulator and others of saying that we had, over 70,000 schemes, more than all of Europe combined. It's crazy stuff.
Okay.
Actually, that includes individual single-person schemes, which are not pension schemes, they're tax planning vehicles. So it suits the narrative, when you want to drive a big number. But we've seen massive consolidation. Now, on the pensions front, I suppose Ireland tends to follow the UK maybe 5 or so years later. So we haven't yet got to that stage of Uber drivers and hairdressers having to disclose their significant votes. Thankfully, we'd hope to avoid some of the worst excesses, I suppose. What we're driven more by is probably out of Europe in terms of the IORP2, the Institution Occupational Provision. And that is being used to raise standards, to improve the level of governance, the professionalisation of trustee boards. There isn't a requirement that you must have a professional trustee, but nonetheless, and they're trying to encourage the continuation of lay trustees within that, because they do have a lot to add. But every board must have at least one person who has a professional qualification and at least 2 years' experience. So in terms of the reporting, it's more around TCFD for the larger schemes, and it's an overhead, it's a governance. The most recent piece now we have is the Digital Operational Resilience Act coming from Europe, which is all schemes to be compliant by the 17th of January. And it really feels, as a practitioner, as a trustee, that there's just been wave after wave of opportunity for fees for the consultants. And everything is used as an additional cost.
Yeah.
And even that in itself is being used to drive further wind-ups and consolidation. So of the DB schemes that survived 2008, 9, 10, the number is now probably half of what was there 10 years ago. But funding has improved dramatically as well, and de-risking has taken place. So schemes the ones that survived are in good health, but they're feeling a huge pressure from overhead and compliance pieces.
Yeah. Okay, cool. So let's just do a recap. So stewardship's not effective, it's not delivering. That important to define what we mean by good stewardship with a focus on collaboration, systemic stewardship, policy engagement, and on behalf of the asset owners. That if stewardship is practiced in that way, asset owners may be prepared to pay for it. That the disclosures are not incentivizing the type of actions that we want asset owners and their managers to take. Let's try and dig a little bit more into this policy engagement and systemic stewardship, because it may be a bit new to some people. Caroline, I wonder if you could just give us a sort of a definition of how you think, you were the first one to raise this, I think, how you would define systemic stewardship. And then I'd like to unpack a little bit more about what it involves.
Okay. We see system-wide stewardship. We really call it, actually, when talking about it to our members, as big picture stewardship.
Okay.
So thinking about those big picture issues that are, and there are quite a few of them, but they're most likely to affect our slight tweaking of what would be a sort of the world market, as it were. And if you start thinking about that way, you start thinking about the big picture issues, and what are the best ways to tackle things, what are the most resource efficient way to tackle things that affect most, if not all, of the companies in your portfolio. And that brings you remarkably quickly to thinking about public policy advocacy as a really important stewardship tool.
Yep.
It also implies a much greater dedication of resources to, I think, collaboration with others. So collaboration with other asset owners in particular, and because, I think Leanne and I both agree there's a very distinctive asset owner voice on a lot of these issues generally. I think, and actually Railpen gets a lot of value out of this, it also implies collaboration with bodies that you wouldn't necessarily collaborate with. So membership associations. Railpen has produced guidance with people like the PLSA or the CIPD aimed at companies on system-wide issues, but bringing in their policy expertise and their networks as well from different sides of it. And of course, it also implies, as we've discussed previously, thinking about how you can use your voting policy or work with your asset managers on their voting policies to exercise decisions in a systematic way across your portfolio.
All right, that's really helpful. And I want to go to the comments that Catherine raised earlier around the Trump presidency and the political dynamics of the US and how this might affect US asset manager behavior. I'd like to put it to you, Catherine, that some of the asset managers that you may be speaking about were never that committed to responsible investment, that it was a free-for-all, it was a Wild West out there. They were able just to sign up. And now the Trump presidency is going to force them to commit or not to commit. And that actually if responsible investment is to mean something, then it's not for everybody. And that this is actually an opportunity for us in the responsible investment industry, I mean, sort of geopolitics and all the chaos that's going to come aside, to really understand who's in on this journey and who's not.
Yeah, for sure. So, by the way, I do think that one of the things, we do a lot of research on this at ShareAction, and one of the things we've observed is that European asset managers, including UK, but actually particularly on the continent, have really maintained and continued to accelerate the progress of becoming more ambitious in stewardship. So there's a huge bifurcation across the world market for asset management services, which in my view presents a tremendous commercial opportunity for European asset managers who can really pitch to asset owners all over the world and clients, retail clients too, that they have a really sophisticated, ambitious, credible, structured, systematic approach to the protection and enhancement of value by having really purposeful and outcomes-orientated dialogue with investee companies in particular, and investments. It might be infrastructure, it might be private equity, it might be bond issuers, or it might be public equities. But in all cases, there's, in my view, a stewardship done well. And as I said at the beginning, most of it's not really as effective as it could be. But done well, it really is an activity at the heart of investing for the long term, generating really good long-term returns, and being able to take your pension one day in a world which hasn't been jeopardized by externalization of cost and risk by your own investee companies that were part of your portfolio. So it should be you know, when I said it's not working, I really want to put that in the context of saying I fundamentally believe stewardship's really essential to good pensions management, for example. And it's incumbent on the fiduciaries, i.e. the trustees, to differentiate between good and bad out there in the asset management marketplace and to ask tough questions. And because we're seeing this really interesting bifurcation of standards, which, as I say, is, in my view, really regrettable, some of the kind of politicization. And I really feel for some of the people that work in US asset management companies who are really committed to this, but where over their heads, you know, this has kind of got really, really hot. But yeah, it's an opportunity for us here on this side of the Atlantic, and I hope we can grab it. And it's very important that our own policymakers and financial regulators stick with it, which is why I think it would be super regrettable if the Financial Reporting Council sends a signal of kind of limp ambition around stewardship as an important part of asset management practice.
Okay, that's really helpful and clear. I'm going to put on the next poll question, and then I'm going to ask Leanne a separate question, because this next poll question is way too long, and I'm really sorry. I worded it, so I'm going to read it out for you. So pension funds' largest asset manager has performed from a financial returns perspective and has strong stewardship resourcing, however, has voted in ways that are inconsistent with the pension fund's beliefs. What priority, so like I'm looking for one here, action would you expect those trustees to take? So do nothing, performance was expected, reporting strong. Continue to engage, understand the rationale. Set a deadline for a change in approach, the implication being that you terminate the relationship, or terminate it now, and as I said in the question, it's been going on too long. Now, while you reread that, I'd like to ask you, Leanne, to unpack a little bit more about your comments around collaboration, and in particular around how your sort of views on identifying strategic partners among the asset owner and asset manager community, some of the groups that you're part of, and how you go about that in order to effectively work with others to achieve your stewardship goals.
If you wouldn't mind, I wouldn't mind just sort of commenting a little bit on the product versus firm level alignment, because I just think it's really, really important.
Let's do that.
Yeah, because we're just in a really complicated landscape right now, and whilst I think the golden carrot for some asset owners may be that they will wish to switch to European managers, but for a lot of asset owners, that may be not on the table for them to consider, and they may be remaining with their US managers. Yep. And therefore, as a result of that, they're left with a firm level misalignment, because it's likely that that US manager will not be able to strategically partner with you on policy engagement, which would be ideal, right? Because they have more AUM than we do. And you're left possibly with product level alignment. What do you do with that? And I just think we need to work together in collaboration to develop pragmatic solutions around this. I'll kick around a few ideas that have been thrown at me recently. I'm not sure if they'd stick with legal teams, but it's just an example of we just need to start the dialogue around this. So in other words, what if we were to introduce side letters or mandate? To what degree does the mandate, construction of the mandate, how much protection can the fund manager get in adhering to my stewardship requirements with the mandate construction? That's point one. And then could they possibly, for example, if I wanted that fund manager to sign up to investor statements on climate change, that they wouldn't be able to do at a firm level for all the reasons we would know, but could they sign up on behalf of certain clients and caveat that? So, I mean, there's many other examples we possibly could come up with here, but I just feel like for the reality of some asset owners where that's not on the table, what are the practical solutions that we can work towards as a community for those asset owners that are in that difficult position, so that they can, it is not maybe the ideal scenario, but some kind of halfway house proposal.
Why might it not be on the table? I don't understand that.
Because at a firm level, they might not, it's too much of a legal risk for them to be signing up to climate for fear they might get sued.
Yeah, but why might an asset owner not be able to stop working with an asset manager that's not philosophically aligned with them at entity level?
Why would they not be able to?
You started your comments by saying there's some that's not on the table.
Meaning, what I meant by that is that firing the manager may not be one of the escalating.
Because you're locked into a mandate, or you're overall.
It's just the reality of it, right? Yeah. I know we would like to say in an ideal world, okay, it's has a heavy weight because systemic. I mean, if you take the belief down to implementation, it should weigh quite heavily, right? Like, you know, and I absolutely understand that from what Catherine's saying. I'm not disagreeing with that, but I'm marrying that up against 15 years in the industry of the reality of the challenges of asset owner professionals and what they have to deal with in terms of their own buy-in challenges, right? Not everybody has perfect buy-in here. And so therefore they may have to live with certain decisions. And so as a result of that, what are the practical solutions that they can explore under that reality?
Can I ask you one more question, Leanne, on this? And if you don't want to answer it live, that's completely fine, and we'll move on.
I'm nervous now.
There's if you accept that these are systemic issues and these systemic actors need to send clear messages to the companies they own, by providing essentially split views on this, because they've got a divergent client base.
Oh, I know, that's a good question. Well,
they're undermining, it's just undermining the role of stewardship entirely, because the company's confused about what the asset manager's expecting of them.
You're right, I did say halfway house, I didn't say perfect. Like, it's just one of those things where it's not gonna be perfect, whatever these, I'm calling them pragmatic solutions, but I didn't mean to say they're perfect ones.
Yeah.
I'm just trying to put a reality check on what it's like to be a responsible investment professional working in the owner space.
It's important.
It can be challenging, and so therefore you have to work within sometimes a restricted reality, and so therefore your only other choice is to come up with, you know, imperfect solutions.
All right, so let's go to our poll answer and put that to you, Jim. So this is a reminder that essentially the voting's not been aligned with your philosophy, and that the audience, by just over a third, would say they'd set a deadline and there'd be whatever the phrase is, but a conviction behind that deadline. They'd be happy to fire that manager if that manager didn't meet that deadline. Is that your view?
I think that's probably just kicking the ball down the field, you know? I mean, it's saying, we're not happy what you're doing today. I'll give you another 3 months, 6 months, 10 years, and then I'll see am I happy with you. If it's at that extreme, then why just don't you terminate the relationship now? It is a difficult one, it's a challenge. I mean, I have a real current issue with a client where there's an objection to the fact that the indices include a number of companies that are on the United Nations blacklist. And we've approached the fund manager, we've had meetings with the head of sustainability, they've had discussions with the index provider, and they're not willing to change. And actually it comes down to a difference between blacklist and sanctions list. So if you're on the sanctions list, then you come out of the index.
Yeah.
But the blacklist, but the companies we're talking about here, and this is in relation to Israel, Palestine, Gaza, Airbnb, Booking.com, Motorola Services, you know, I mean, they're big global companies, but they're on the UN sanctions, the UN blacklist.
This is the Global Compact list of human rights breaches.
No, it's another one.
Is it? Okay.
It's another one. And so what do? You've approached, as the trustee, we've had an approach from the sponsor. We're aligned with the sponsor. You know, we consider carefully our fiduciary responsibilities. I might give you an aside on that in a second, but we've approached the fund manager. They're not really even willing to approach the index provider, and they say it's a political issue. So actually, the trustees of that board are meeting next Thursday, and we're considering not just exiting from that index and from that manager, but exiting public equities completely. Now, it kind of links back to the funding level and the fact that there's only 4% inequities in this scheme anymore, and it doesn't need the equity risk. But it would be the first scheme I have that I've ever come across where they have 0 equities. It's a bit of an extreme example, but it is a reaction to a pragmatic problem that says, well, you can't square it any other way.
Essentially, you're saying that the structure of the market means that the asset owner is not powerful enough to set a product that they reflects their beliefs.
Yes, and the scheme is too small to go on a segregated mandate to actually go self-select.
Which is a market structure issue.
Because the costs would just be so prohibitive compared to the exposure that you have today.
Okay.
So it's finding a pragmatic solution that isn't perfect, but it's working against the market structure that says...
I feel the same way. Sorry, go ahead.
Oh, no, if you're... So I was going to ask to comment on another poll finding. So
Sure.
finish that off.
Well, I was going to say it's the same kind of, I consider split voting to be the same way, but I don't want to go on.
So I'm quickly losing control of the panel.
Sorry,
I've got a script and I want to keep going, but I'm also conscious that we've got about 8 minutes to go in a session, and I did want to see whether there are any comments or questions, and I'll take them in threes. Anyone brave enough to put their hand up? Reflections on what you've seen so far?
Oh dear.
Yes, please. Just say your name and your firm.
I mean, I've been watching this debate both here and also in the US, and seeing the evolution of, ESG and then stewardship, and just how embedded that gets with a lot of the asset managers. I work with LGPS, and they've been very focused on this for quite a while. By the way, your industry-wide thing is, I think, the LAPFF, isn't it? But that aside, it's just seeing how embedded now all these considerations are, and all the asset managers with their own models trying to compete on that. And if you think about examples like, Boeing or something like that, these are just sort of catastrophes of G. And so I would just say that it's just become sort of part and parcel with just good analysis of investments, and doesn't necessarily need to be parked outside like something extraneous you either do or don't have. And so I would think that this may be less of a threat than it at first appears, given all the talk in the US, just because you should do just better company analysis.
Okay, thank you for your point. Anyone else want to come in? Yes, please.
Sure. Hi, I'm Sarah Forster, CEO of the Good Economy. I was curious, we're seeing some asset managers who are going for the SDR label, particularly in the public markets, needing to demonstrate how their stewardship actually influences the company in a way that you can evidence a change in outcomes, if you like. I'm just curious where, and they're sort of struggling, I would say, to show that journey and how they report on that. Yeah, I just welcome the panel's experience and what good looks like. In that regard.
Good question, thank you. One more? Yes, please, over here. Keep you walking, keep your step count up.
Get rid of lunch.
Thanks. You mentioned that some of the, Brendan Walsh, that current reporting isn't very useful, it's not decision useful, not helpful. And personally, I would agree with quite a lot of that sentiment. But I suppose the question is, what does good reporting look like? Who should be producing it? How can we come together as an industry to try to produce something which is more decision useful and help to drive progress and take some of that overhead, as Jim mentioned, out of industry?
Okay, all right, that's excellent. I'm going to weave those 3 questions into the final 7 or 8 minutes that we've got. I'd like to throw something slightly different to you, Catherine, that's not been spoken about so far, which is around member communication and preferences, and just understand what your view is on the extent to which asset owners, asset managers should seek to understand them and incorporate them in their stewardship.
So I'm very, very committed to this. I think it is important to remember whose money it is. Whilst on the one hand, members of pension schemes deserve and should get really expert, really professional fund management services, it's, I think, incumbent on asset owners to have some sense of what members' priorities are, particularly when it comes to these more systemic social and environmental considerations. So, for example, climate considerations, really obvious one, nature as well. But what always comes up when members are asked is their extremely high commitment to investing in companies that treat people well and are serious about workforce good practice, which is not that surprising given that people that pay into pension schemes are workers. But it's a very sort of limited theme. It's a good example, I think, that it's also entirely risk relevant, and it's relevant to kind of building the kind of economy that people want to live and work in. So why wouldn't schemes be engaged with that, take it seriously? By the way, I think the work that Railpen does on this is fantastic, and that's partly because it's a much more member-centric kind of worker-engaged scheme than some others. So and ultimately, and this is another sort of related point, in a DC world, what's crucial is that people have confidence in their pension provider and are actually willing to contribute sufficient money into the scheme every month out of a paycheck, that they've got a realistic retirement prospect at the end of the day. And good ESG communication engagement can really help with building confidence. A point that I was discussing this morning on a different event. So it's a real win-win, but people in the investment community either find it sort of onerous or daunting or frightening or find a million reasons not to do very much of it.
Yeah, okay, all right. So I want to pose that to you as well, Caroline, but I'd also like to bring in Sarah's question around, I'm not sure whether the SDR labels are relevant for your setup, but whether or not this link between stewardship and outcomes that's embedded in the improver label is something that you are comfortable commenting on.
Yeah, absolutely. So I'll start on the member piece first. Thank you very much, Catherine, for your kind words. We do spend a lot of time thinking about how we communicate to our members on sustainable ownership, because we agree. We think that if you can talk about what you're doing with the companies that you invest in on the issues that members tell us they care about, and is always fair treatment of the workers, fair pay, climate change and biodiversity are always sort of the top four, then that can help make individual savings feel real to them, and that can help build trust and boost member engagement overall. So we try to think about it in a structured way every year. We publish a condensed version of the stewardship report, about 15 pages long every year. We let that settle for a bit. Then we do a survey of our membership to see whether it's landed, what their priority issues are. We do that year on year, how they'd like to be communicated with, sustainable ownership as well. So they want more digital stuff. They want it smaller chunks more regularly. We work with Quiet Room as well to do roundtables every few years with engaged with ESG members and self-described non-engaged with ESG members to try to understand how we can reach the people who aren't already signed up to it.
Yep.
And then when it comes to outcomes reporting, I agree that it is, even we struggle to really try to tell the tale in a way that makes sense in terms of why we decided to engage with that company on the issue that we decided to do it on, how we thought about the kinds of stewardship levers we pulled and in what combination. Over what time scale did we engage with that company or vote against that company or do a pre-declaration against them or co-file a resolution at that company's AGM? And then what was the outcome? And we try to be, and we don't necessarily see this very much from the asset managers we do use, we try to be as fair and transparent as possible and to talk about lessons learned too. That can be really tricky when you've got a regulatory environment that's sort of focused on, or a commercial environment at an asset manager that you're focused on trying to demonstrate that you've achieved good outcomes. Sometimes we see several asset managers claiming almost sole responsibility for the same outcome at the same company, which is always interesting. We try not to do that. We try to be honest, but it's tricky, and I agree that there's a way to go.
Okay, all right. We've got 3 or 4 minutes left. I'm going to ask a question of Leanne, a question of Jim. I'm giving Catherine fair warning, but I'm going to give you the last word to give a rousing speech around how we can address the consultation that the FRC has put out, and I'm going to provide you with a quick summary of what we said. Leanne, I'd like to go to Brendan's question around good reporting. Is there such a thing?
Well, I mean, I'll focus on stewardship. I think, everybody's fatigued with reporting. I understand the regulatory burden is real, and obviously the various regulatory bodies need to join up their thinking around this kind of stuff and not operating in silos for sure. But, I just don't want to kind of completely always blame, regulatory bodies for the reporting, because at the end of the day, it is our responsibility to take the information from reporting and make it decision useful for us. Like, take implementation statements, for example. The purpose of implementation statements is not merely to extract voting and engagement information from your fund managers, ask them what their significant votes are, and then merely translate them into a report. The purpose of it is to use that information to hold fund managers to account. So I just think there is a bit of a fail there in terms of implementation statements, but I don't think it's the fault of the implementation statement. It's the fault of how we're actually using that information to drive better stewardship and monitoring of our fund managers. And on the stewardship reporting front, I mean, I've banged on about this so many times on panels, but I am seeing, I'm going to put a positive spin on this. I've seen massive innovation in terms of fintech companies coming out, in terms of being able to have like software platforms where you can see the tracking of engagements, the milestones, the progress against them, and then any voting escalation on the back of that. And then perhaps if you've had successful engagement, perhaps revisiting that company and finding out what has been the positive outcome of that engagement on the bottom line of that company to kind of fully bring that outcome story to a close. So I'm seeing a lot of great developments in this space over the last few years. So, that as opposed to always saying, oh, I want this, this, and this from my fund managers, I wanted to spin that into a positive development, which there is more than enough kind of software platforms, et cetera, out there that fund managers can start delivering sharing that kind of live information to their clients, and that's actually really useful information, right? To have that full stewardship narrative from the milestones, the escalation, as opposed to having this piece of information here, you know, voting information here and engagement information here and so on.
Yeah.
That's not very helpful.
Okay, all right, super. So Jim, same question for you, and maybe comment a bit on Elizabeth's question around whether or not this is just essentially embedded. My view is not, that it is distinct. But whether ESG is something distinct, whether sustainability is something that's just embedded and just something that fund managers do, or whether there is something that makes it a slightly different approach or different approach.
I think if I had a euro or a pound for every time a fund manager said to me that ESG was part of their DNA, I'd be a rich man. Yeah. It's a real trigger for me to annoy me, a fund manager. And in fact, I remember a couple of years ago during COVID, an online conference where, again, a fund manager was talking about ESG, and in the background it wasn't environmental, social and governance, it was economic, social and governance. They actually didn't, between them, you know, a person did the slides and a person speaking, but they were telling us it was part of their DNA.
Yeah.
So is it embedded? Is it embedded? No.
Yeah.
You know, it's being worked on. It is something that lots of people are committed to. Unfortunately, I think, you know, even again, referring to our situation in the transposition of IORP2, the regulator for the first time said that trustees must consider ESG as part of their operations. And one of the major legal firms, well, said that just means you just have to consider it. You know, which I thought was really poor, really damaging to the whole piece. Again, you know, funding levels in DB schemes in particular have improved dramatically in the last couple of years. So there's a shifting sand even in terms of where the risks are and where the exposures are.
Yep.
And that's leading to some changes on it. I think there are trustee boards and there are fund managers that are further down the curve, and there are some that are still laggards. But for me as a trustee, ESG is simply part of risk management.
Yeah.
You know, it's always about return, it's always about risk, it's about regulation, and it's about reputation.
Yeah.
And if I see it as part of risk management, well then it has to be embedded.
Yeah. Okay, all right. Super, thank you. So let me just give you a quick recap. The title was around stewardship and governance, and it's titled Navigating the Labyrinth. We had a pretty strong view across the audience that stewardship's not working, shared on the panel 3-1, although I think the scores probably don't reflect quite the views, that there's some nuance here. There definitely are green shoots, but it's certainly not reached its potential. That asset owners are prepared to pay for good quality stewardship, but we need clarity on what that stewardship encompasses, that it should be asset owner led, that it should include collaboration, that there should be a policy focus. There's mixed views on the transatlantic divide, and Leanne put forward some practical steps around how we might navigate that, but notwithstanding the challenges that this is going to involve, certainly over the next 4 years and potentially for much longer. That systemic stewardship is an incredibly important part of how we undertake stewardship, but we're trying to navigate changes in skill sets, increased policy professionals, and the sort of timeframes and so forth, and challenges involved in that. The importance of capturing members' views, that was a view that was shared across the panel, and that can lead to more member engagement in their pension products. And then while it's important that we link stewardship to outcomes, there are certainly challenges in doing that. A big thanks to our panel, but I want to give Catherine the last word. We've just run over, so you've probably got like 30 seconds max, but can you just give us a sense of what, if the audience are minded, what should they say in response to the FRC's consultation?
I think people should say, don't fiddle. Like, we only just settled on a 2020 code. The first code came in 2012. Then we had a long period of that. Then there was some really, really thoughtful work at the FRC about what needed to be revised. We got a new code in 2020. It's far too early to be fiddling with it. So I think there's an enormous cost to disruption, and people should resist it and send that signal clearly. And actually, stewardship's been an area where the UK has shown serious global leadership, and it would be most retrograde to the whole of the UK industry, and certainly ultimately to the millions of pension savers in automatic enrolled schemes and so on, who really depend on prudent oversight, and the code helps to support that. So let's not mess about, and please do send that signal to the FRC, because if they hear it from market participants, it really will, I think, have real influence. And I should say that I know that the FRC will listen, I believe they will. The FCA has got more and more engaged and supportive. I don't think they want to see this happen, I hope not. So please take a moment to look at what's being proposed and discuss it with other like-minded, responsible investors in your workplace, in this ecosystem, and let's send through a nice united signal to the FRC.
Super. Someone lost a ring. If that's yours, come and get it. Thanks so much to the panelists. Thanks to you.